What is debt to income ratio? We're going to get into the nitty gritty right after this. Before we get into it, we would love it if you would subscribe to the channel. We talk about all things buying and selling real estate and occasionally what it's like to be a real estate agent. So please subscribe. We would love it if you would. Now, debt to income ratio. If you have applied for a home mortgage, you have probably run into the term debt to income ratio. If you haven't applied for a home mortgage and you're just thinking about buying a home, if you've done any sort of research about what it takes, you maybe have run into this term debt to income ratio. Now, it's pretty simple. When you apply for a loan, one of the main things that a lender will look at, aside from your job, the cash on hand, your credit score, they will look at your debt to income ratio. So currently, how much debt do you have relative to your income? And then they take it a step further and they look at, after you purchase a home, how much debt will you have relative to your income? Now, most lenders will want to keep you somewhere in the 40% range, meaning 40% of your income is going towards debt service. So that would include your mortgage that they're going to give you. That would include if you have a car loan, student loans oftentimes as well, and any other type of loan. They want to keep that in the 40% range. Now, lenders will push it up to 45% sometimes, and depending on all extenuating circumstances around your financial picture, they can push it upwards of 50% debt to income ratio, but that's really toeing the line, and lenders typically, if they're somewhat conservative, are trying to keep it under that. If you're coming into the approval process for your loan with an already high debt to income ratio, you can work with your lender to look at different ways that you could pay off some of that debt so that when you obtain your home mortgage, you're in an acceptable ratio. So that might mean paying off a car loan, maybe paying down some student debt, and doing so as a part of your pre-approval process so you can get approved in the first place, or maybe approved for a little bit more home that you're wanting. So that's it for now. Debt to income ratio is pretty simple. How much debt do you have? How much income do you have? And you compare those two things. Lenders really look at that, and it's an important number that they're going to cite when they're talking to you about your finances. I hope you found this helpful. For more tips and tricks, follow us, subscribe to us, sign up for our email newsletter. We'd love to have you be a part of what we got going on right here. See ya. Bye.